I think it probably should have already, to be honest. When I look at the economy right now, including this week's data, lots of data this week, but the big pieces were, I think, that inflation a touch below expectations, the economy a touch weaker than expectations. I think the balance of risks between those two things has changed quite a lot over the last 6 months, with the risks for me now firmly skewed towards the economy and towards the downside. And that's why I think, for me, this is the time that the bank should be considering very seriously withdrawing some of the tightening that it put in place over the course of the last 18 months to cushion those risks to the economy at a time where inflation now is falling at a fair old click, and I think set to hit target by perhaps Easter time and then remain around target. So for me, I think now is the time to be speaking a little bit more firmly about the need for cutting sooner rather than later.
Well, we're already in a technical recession. Are you worried that this could get even deeper if the Bank of England doesn't turn to cutting rates sooner?
I think that's where the balance of risks lies, yes. I mean, it's true that the data for this year so far, such as it is a bit brighter than the tail end of last year. The jumping off point last year to this year looks to be a more positive one. Surveys of businesses, surveys of consumers, surveys of housing, all pointing to a somewhat firmer start to the year. But I still think we're looking at a year at best of anemic growth, with the risks to that outlook still skewed pretty firmly on the downside. So for me, the case for putting in place some upfront early insurance on the monetary policy side is strong and strengthening, and I'm fearful we leave that insurance a little too late in the year.